today on Rethink Real Estate, a little bit more of a different concept from an investment perspective. And I try to just bring you different things in real estate, just to make sure that it's not just residential real estate. And today, Cameron Hastings is joining us. He is a pretty detailed expert when it comes to unanchored strip centers. So yes, strip malls. Okay. The dingy buildings on the side of the road that have smoke shops and laundromats and whatever it is that he takes us through a really interesting understanding of the concept of these as assets. And I have to be honest, I went into this going, this is going to be a bit weird. But I like the idea of it. Makes a great deal of sense because I've seen commercial developments that have had anchored, and what an anchored one means is that there's a big box shop in there that then a target leaves and it completely devastates the entire area. So again, listen in. Another great concept. It could be something that you circulate through to your investors to get them to understand that you could be part of representation of that. Understanding the different avenues that are available to you from a real estate investment side of things is always important, and genuinely curious on this point. So I ask a few questions along the way, but hopefully you enjoy. Welcome to Rethink Real Estate. My name is Ben Brady, and this is a real estate podcast aimed to deliver sales strategies, marketing tips, and business insights from industry experts and myself to build a listing-focused business for the future. Let's get into it. Cameron, welcome to Rethink Real Estate.
Thanks so much for having me, Ben.
Now, you've got a bit of a unique sort of approach to an individual sector of real estate that we haven't had on the podcast before. So we're going to dive into that here shortly. But at the moment, just a little bit about who you are, the company that you've obviously helped found, and things along those lines. I'm curious to understand all of that.
Mm-hmm. Sure. So the company that my partner and I, Lori, founded about 8 months ago is called Selling Bright House. And we're focused specifically on unanchored strip centers in Southern California and Dallas-Fort Worth.
Right.
But before I get into that, maybe I can tell you a bit about myself and kind of how I got to this property type and this particular focus.
I always like to hear the journey of people because it's one of which it's kind of interesting to understand how you got into that. But before you dive further in, what's the unanchored strip center? What is that for people that are like, what do you mean?
Sure. So it's a subset of the retail real estate asset class. So the strip center portion refers to generally the shape of these buildings. So they're generally straight line buildings. Sometimes they're in an L shape. In Southern California, where many of your listeners may be, they're everywhere. They're pretty much the retail centers along the main retail corridors. And the unanchored part refers to the fact that there aren't either big box spaces, so they're all inline spaces. And they typically have smaller tenants that are local businesses rather than global or national businesses. So that makes it a little bit different than either a power center or definitely different than a mall.
Yeah, absolutely. Because when you say unanchored, that makes total sense in the sense that you don't have like whether it be like a PetSmart or a Costco or whatever it is, like a big box company that's ultimately in there. So really interested to explore that with you a little bit further. But how did all of this get started?
Mm-hmm. So I started my career as an architect, designing high-rise office buildings here in New York, where I'm based. Primarily for companies like REITs or some insurance companies or large asset owners. And through that process, realized that I was really more interested in what they were doing than what I was doing as a designer, and that the scope of my work was more limited than I wanted it to be. I wanted to be in control of the overall process from the very beginning of the concept all the way through operations and eventually selling the project. So I went back to school, got my master's in real estate development, and since then have been a multifamily developer, developed a couple of apartment buildings in the New York area, and then went on to Newmark, where I was a managing director focused on portfolio strategy. And that's really where I got the very broad sense of different property types, different geographies, and different owner profiles. So there I worked with both owner-occupiers who were using these office buildings or retail centers or industrial properties for their own uses, as well as investors, and seeing the differences between how those different owners think about properties, and just how to think about properties as a portfolio rather than asset by asset, and how those can work together. So that was really a valuable experience for me in getting into actual investments.
It's funny that you say that, is that thinking about things from a residential real estate perspective, which is predominantly what we speak about on this show, and we bring people like you into the show to get people thinking a little bit more, laterally, in the sense that it's not just about individual single families or condos or anything along those lines. Even the multifamily space is a space that, doesn't get overly understood as much when you're just doing residential resale. However, the thing that you just said is that not thinking about just individual transactions, or as an investor, individual properties, and actually thinking about it more from a portfolio perspective, is something that, I think is a skill set that you have to be exposed to, like you, to really, or exposed to people like yourself, to really get a very firm grasp of how to really think about that portfolio versus just a whole bunch of single family homes or whatever it looks like in that sense. But going deeper into this concept of finding the niche, so to speak, within the marketplace with unanchored strip centers, I really want to understand how you got to that point.
Mm-hmm. Sure. So there's a couple of things that we really like about this particular niche within retail. One is that it's still a highly fragmented market. So about 95% of these properties are still owned by individuals or families that maybe own one or two of them. Typically don't own very many of them. Whereas in malls, for example, regional malls, about 90% of those are owned by institutions. So this is almost the inverse of that, where institutions only own somewhere around 5%. We're starting to see the early institutional adoption here. So the first REIT that's focused just on these property types spun off from another general shopping center REIT in October. We're also seeing some large institutions like JP Morgan, Nuveen launch vehicles that are specifically focused on this. So in both those cases, we're seeing echoes of what happened in single family rentals around 2008, 2009, the beginnings of that, as well as what happened in self-storage starting in the 90s, where these properties that were considered too small as individual assets have started to become institutional kind of quality properties. And the way that they do that is by assembling portfolios rather than focusing on asset by asset.
So my immediate knee-jerk reaction when it comes to, like, I think about from a commercial perspective, is that I think about, I want a anchored strip mall, because at the end of the day, I want to have that big box company that has some format of stability that then obviously can then draw people into, that then the ancillary businesses around that then get that crowd. I guess, but that comes with a pretty large price tag attached to it, I'm assuming, versus something that's unanchored. The volatility of the unanchored strip mall is something that I immediately go to. Can you correct me on thinking about that, or is it just, or do you lean into the discomfort of understanding that that is what you're probably going to have to deal with?
So that's definitely a factor, and we take risk in different ways. So if you're focusing on credit anchor tenants, there's the risk that if that space goes vacant, you now have 20,000, maybe 100,000 square feet of one large big box space that really only another national tenant can take. So your vacancy periods between tenants can be much longer than in an unanchored space. In an unanchored center, you will have more tenant turnover, but these spaces are pretty small. They're 500 square feet to maybe 2,500 square feet. The largest among them, maybe 7,500. So there are a lot of businesses that can take those types of spaces. So even though you may have more tenant turnover, the time to release those spaces is generally shorter. The other benefit versus anchored spaces is that the leases themselves are shorter, so you can bring rents to market faster,
Right.
And you typically have higher escalations. So if you're renting to a Target or a Home Depot, you may have no escalations for a period in the lease, or very low escalations, maybe 1%.
Yep.
With the unanchored space, you almost always are above inflation. So you're 3, maybe 5% for a very small space. So just that advantage of the built-in escalations and the relatively short lease periods means that you can outperform more traditional retail properties over a similar time period.
Right. Well, and again, as you say it might be a little bit more heavy lifting, but at the same point in time, the diversity of the space is probably something that is a distinct advantage. Now, that being said, like when I think strip mall, I don't know why I go to this rundown sort of six, there's like in my head, I've got this sort of this vision of like, say, six individual spaces. One's a smoke shop. The other one might be, like a laundromat. The other one might be like, I don't know, like a massage, like a nail salon or something like that. Like there's so many things that just come to mind in that sense. I guess, how do you go about identifying an opportunity? The opportunity that you mentioned before is there's less institutional people in this space. There's obviously growing competition within it because they're probably realizing that it's a good portion of their overall real estate portfolio to have some of this versus the big box stuff. But I guess, how do you identify opportunities? Like, I know that if we were looking for flip properties in a residential perspective, we'd probably get on the phone, have a look at the tax, the tax lien side of things, the people that might be in default in that side of things, look for expired listings, look for all of these different avenues. How do you find out the information to sort of identify these opportunities?
Mm-hmm. So we have a number of brokers that we work with that focus specifically on those two markets and specifically on these property types. So we're generally sourcing properties that are on market rather than going directly to owners or trying to find properties off market.
Mm-hmm.
When we're evaluating properties and exactly what we look for, typically we're looking for pricing somewhere between a 7 and 8 cap, which is much, much higher than you'd be able to get with an anchored center or credit tenants.
Right.
So that is an advantage there. Generally, performance has been quite good in terms of occupancy across the country, and especially in Southern California, vacancy is below 5% and has
Wow.
been for about 12 consecutive quarters. So these centers are essentially full. And right now it costs somewhere between $500 and $600 a square foot to build a new center, whereas we can acquire them for as little as 200 a square foot. So the incentive to develop new competitive supply is also significantly diminished, not only because of the interest rate environment we're in, but just because construction costs have really outpaced the value of these existing properties.
Yeah, it's kind of a little bit of a time warp, and it feels like it's going a little bit in reverse. It's kind of the Benjamin Button theory with the way that these centers, in my head, but like the way they look and the way that I've got a perception of them versus the way that the reality is actually going. Because if you think about it, if you were to acquire, say you acquired 100 unanchored strip centers versus one major retail center like a Westfield or something along those lines, I think I would prefer the strip centers based on the fact of the pressure within retail at the moment with the online side of things is quite fierce. I would say is that there's some malls that it's kind of like I probably liken it to this. And Cameron, tell me if you believe I'm wrong in any of this. You probably have far more insight than what I do. I read something the other day on The Real Deal that stipulated that the downtown San Francisco marketplace has the perception of being absolutely decimated.
Mm-hmm.
Now, that being said, that's actually not the case if you were to go into remodeled office buildings that are beautiful spaces and that are high functioning from a perspective of amenities. They are actually 100% occupied, but anything that has a little bit of age on it, anything that is remotely remotely old, is that they're the spaces that are being rejected. People want, the Class A, they want something really nice and it still serves that purpose. I'm actually looking at it in the sense of that the retail, like shopping mall, so to speak, is something that's sort of dwindling away because it's more from an online presence perspective. And the strip mall side of it, the laundromat isn't going away, the smoke shop isn't going away, the real estate shop front might be under a little bit of pressure, but that's something that I think about with an unanchored strip mall as well. Like there's all of these individual little businesses that are not under immediate retail pressure as much as, say, the bigger locations are. Is that a general synopsis that is accurate, or is there holes in that?
Yes, that's generally accurate. So the two big distinctions that I see between the malls or the more traditional retail and high street retail, so Fifth Avenue in New York or downtown cities, which are not doing very well either, versus strip malls, is that typically that the former is more discretionary based. So you're going to buy things that you want, not things you need. Whereas when you're going to a strip mall, it's typically more focus on things that you need. So you are going to the laundromat to go do your laundry. You're going to get your hair cut. You're going to get your nails done. You're going to the pharmacy. So the non-discretionary nature helps, especially going into potential slowdown period like we may be going into. The other aspect is that these are typically e-commerce resistant businesses.
Mm.
So some of these things, again, like a laundromat, you just can't do online. There isn't a way to do that. Whereas you can order any kind of clothes or any kind of food really that you would want. Even a grocery store is a little bit challenged by e-commerce. Whereas some of these, especially in-person services, it just can't be accomplished online. So there isn't that same kind of pressure from e-commerce competitors.
Question for you that I sort of comes to mind for me is that is it Cody Sanchez? I don't know if I'm saying the name right, but it's a lady who speaks about the non-sexy businesses of like
Yep.
going and buying a laundromat, and they're saying that the boomers are coming up in a situation where their kids aren't wanting to take over their businesses. So like the small hardware shop that hasn't been run out of town by the Ace Hardwares or the Home Depots or whatever it may be, or the laundromats or the smoke shop or the whatever it is. I'm trying to make up stuff in my head, but I can't. Or like the Indian restaurant or whatever it looks like, right? Is that those businesses are not being taken over by the kids. The kids don't want any bar of it, so therefore there's a distinct opportunity for people to come in and take over those quote-unquote unsexy businesses. However, I still think that there's going to be a gap in the marketplace, there's no doubt about that, where the people are aging out of these, say, quote-unquote unanchored strip centers. Do you see that as a threat to things long term, or not really? Because having a look at the age demographic of what the average age of somebody that owns or is the person that has the lease within a strip center, is that something to be cautious about?
That can be something to be cautious about in terms of that business may not have the kind of longevity that you would want in a long term center. The shorter lease durations do help deal with that, in that you're not expecting them to be there for 20 years. So if a tenant stays in place for 5 years, we're generally happy with that. We may need to re-tenant. We'll have some kind of TI allowance and broker commissions. So there's an expense associated with that. But we don't have the expectation that they're going to be there forever. The other thing, however, that's changed a little bit and brought more foot traffic to these centers in the last 5 years is that so many more people are working from home. So these centers have become really more important in people's lives than ever before, because it's now some people are spending 7 days a week in their local neighborhood, whereas it used to only be 2, maybe 3. So while that high street downtown retail is suffering, now where you're working from home and you can walk to the center to go get lunch or go get a coffee or go run errands during your workday, that has sort of boosted and countered some of the effects of potentially businesses closing or less demand, or owners with children or other heirs that may not want to take over those businesses.
Question for you: if we could go through just maybe an acquisition that you've made recently, and just talk about why you made the acquisition and why it was something that ultimately you move forward with. Like, what were the things that sort of definitely stood out to you? Because again, is that I come back to just my vision of all of this, like having an unanchored strip center, but then you think about the strip centers, I'm thinking about them in the top of my head. Like, I know that there's one here in Newport Beach where I live that on the way home I go past, but it's like, oh no, hang on, that is anchored. There's a Starbucks there. So it's just trying to find these would probably be a little more difficult than what most people think, because a lot of these are being designed around anchoring around some type of major tenant. But if you could take us through maybe like an acquisition that you've recently made and why you chose to make it, that'd be to get an understanding of sort of what was the attraction points.
Sure. So there's a property that we're working on acquisition for right now that I can go through. It's in Cathedral City in Riverside County.
Yep.
It's a property. It's about 40,000 square feet, 24 tenant spaces, ranging from about 600 square feet to about 7,500 square feet. There's no anchor tenant, but it is within a general shopping area. So directly across the street is a Target, a Trader Joe's, a UPS store, a Starbucks. So some of the benefits of anchor tenants you can still have, even if they're not within your property.
That's a really good point. That's great. That's a great point.
So that property owner across the street is, they're taking some of the disadvantages of the credit tenants, but we still get to benefit from them because of that proximity. So that is definitely something we look for. This particular property is also on the main east-west retail corridor, so about 55,000 cars drive by every day. and we're at a hard corner. So a significant number of those need to stop right in front of our property every day. So that visibility is also important to us. And the hard corner, frankly, is very important to us. We don't generally look at properties where you're driving right by, or it's you have to get off the highway to go to it. So that kind of ease of access, being within a general shopping center, and then the quality of the tenants that are in place. So this center is about 95% full, with a pretty wide range of tenants. So there are a couple of restaurants, there's a couple of fitness concepts, one more traditional gym, a couple others that are more like yoga or more kind of alternative fitness concepts. There's a new store that's like a card shop where they have tournaments and games. So there's more in-person kind of interaction there. And some of these tenants, a pizza shop in particular, has been in that specific space since 1997.
Oh, wow.
So some of these tenants are very long term, even though they're continuing to renew on 5-year leases or 3-year leases. But they've kind of proven out that longevity. So seeing a center where at least a couple of the tenants have been there for 10 plus years.
They become a staple of the area, so to speak.
Yep.
While they're not big box, they're definitely very well known locally.
Mm-hmm. So that helps with the draw, but also helps kind of prove out that these tenants are doing well, or they're doing well enough to stay in place. So those are a couple of the things that we look for. We generally are not looking for properties that we need to do significant construction on.
Okay.
We're looking for more aesthetic kind of value add. So things as simple as repainting or restuccoing, improving the landscaping, adding trees, shade trees, bushes, and improving signage, improving the visibility from the street, improving the lighting in the center so it feels safer, even if it is in a safe area.
Mm-hmm.
All of which don't really affect the physical operations of the building in the way that changing out a significant building system would, or adding on to the building would. But they improve the feeling of going there, both for the customers that are going to these businesses as well as for our tenants. And ultimately, the way for us to be successful is to improve our tenants' income. And it's one of the unique parts of retail real estate is that you can do that. By improving the property you own, you can improve your tenants' income, which then improves their ability to pay, which is not the case in residential real estate or most other real estate, where any kind of improvements you make has essentially no bearing on how much money your tenant is making.
Yeah, it's interesting. It's interesting. We are doing a flip at the moment, a property within Santa Ana, and it's a concept that we fitted it out as a smart property. We made it was a single bed, like it was a 1-bedroom property. Then we put a Murphy bed in the main room. That we're just trying this different concept because there was a lot of these opportunities locally, and it was a price point that you think in Southern California would have a great deal of demand because it's around. We're trying to get around between $350,000 and $380,000, and and to do flips in Southern California, as you know, you're in the millions versus in that price point. And it was a distinct opportunity that we got given. And we just thought, hey, let's just try out the concept. And the reality is that we improved this property dramatically internally. But unfortunately, the external of the property itself and the location of it was still so bad that ultimately it just didn't matter. Like people, we were getting so many people that were like, yes, we love it, we'll pay you $400,000 sight unseen. It's like, no, you've got to go to the property and see it, of course. Right. Okay, and then they're like, absolutely not, we're not interested at all, not even at a lower offer. So it's definitely more difficult in a residential sector to have that type of effect that you'd mentioned. So I guess that from a perspective, you've had this company that's been focused in the unanchored strip center side of things for, only just under a year. What is the vision, I guess, over the next X number of years? What does the growth format look like? What are you trying to get from an assets under management perspective? All of those different things.
Mm-hmm. So our immediate goal over the next 2 to 3 years is to have a portfolio of about 6 of these properties.
Okay.
So that would be somewhere between $30 and $40 million worth of property. That's kind of the immediate goal. That would get us to a scale where if we exited the entire portfolio, it would be large enough to go to one of those REITs or go to one of those larger institutional buyers. So if we can put together that type of portfolio, we have a reasonable exit strategy where we could see some cap rate compression based on the efficiency of that portfolio. Beyond that, we'll continue to focus on these two markets, and a couple of reasons for that is one, two of our partners are in those markets and have been for decades, so we have kind of deep experience in those markets. But they're also some of the largest and most active markets for retail centers in particular. About 15% of the entire country supply is in Southern California or DFW.
Okay.
So if we get much larger, maybe we branch out to other markets. But for now, it would be just those two markets. And essentially the same strategy: find well-located properties that are performing well already, but are a discount to replacement cost, ideally a significant one like we're seeing right now, and where there isn't so much operational risk. So it's more about how do we grow this portfolio rather than how do we maximize each individual asset's investment performance.
Well, again, a fascinating sector. And again, Cameron, I really appreciate you giving us some insight to it as well. We'll make sure that all the information is in the show notes so that people can follow along or reach out if they're interested in finding out a little bit more information on all of this. I think it's a fascinating side of things, and I'm just glad that we've had you on to broaden the perspective of hopefully the realtors that are listening as well. But thanks again for joining us on Rethink Real Estate.
Thanks so much for having me. I appreciate it.
So about 75% of our audience hasn't liked, followed, or subscribed to our podcast. It would mean the world to us, and it would help this podcast more than you know to expand our reach if you were to like, follow, or subscribe on any of the platforms that you're watching or listening on. Thanks again.